All right, so I'm a mortgage guy. The session today, and we really don't do a lot of mortgage stuff in the updates. We do about 6 presentations a week to different real estate offices, all on Zoom, sometimes live. But we try to focus more on what's happening in the marketplace so we can get a direction of where to go. A lot of customers ask us, when's a good time to buy, when's a good time to sell, when's a good time to refinance. Well, you gotta understand where we've been a little bit, and you need to understand where we're going to some degree. So that's what we cover off. To start, we look at key dates. So what are the important dates coming up? We know that inflation is going to be coming out on December 19th. The new BOC rates are going to come out on January 24th. The last report, everybody knows the last report was good. And we keep an eye on the US. December 11th is going to be their CPI announcement. Their last one was 3.2, which was down from 3.8, which is very positive. And their interest rate announcement is coming out on the 13th. They are expected to not do anything as well. They should stay flat. Which is good, and I think that, they're actually calling for a potential drop in rates sooner than we are. So we'll see how that plays out, but anytime we can get to a lower rate on the VRM side, the better, right? So we're gonna take a quick peek at inflation. You can see we went down from 3.8 to 3.1 on the headline inflation. Everybody know the difference between headline and core?
Can you elaborate?
Yeah, so headline inflation is everything. Core inflation strips out energy and food. Okay, so right now we had a pause in December. I suspect we're going to pause continuously unless we see some other crisis emerge, and that should continue forward. The tightening of the monetary policy is working, right? Interest rates being high really slowed the market down, and the government wanted to do 3 specific things when they started this endeavor, and that was to restrict or contain consumption, take the pressure off wages, and normalize corporate profits. But you can't legislate for that. There's no way, so the only way you can make that happen is to crank up rates, force the economy into a tighter situation, and then all of that will start to happen. If consumption goes down, it takes pressure off wage because jobs are being lost, and profits start to normalize. So that's the traction the government wants, and we'll talk about the reasons why in a second. But some interesting stats: rents fastest pace of increase in a year, plus 8.1. Mortgage interest rates cost up by 30%. Okay, so we'll talk about that. When you look at if we strip out mortgage interest from the numbers, rent and mortgage shelter from the numbers, we're at 2.2 with targets 2, right? And we know mortgage interest and rent and shelter aren't going to come down. So how are we going to get from 3.1 to 2.2 if mortgage interest and shelter are going to remain high? That means everything else has to contract. And we're starting to see that contraction, but not enough. So we got to really get into a recession to take the benefit of that contraction, so then mortgage interest and rent can come down and inflation follows with it. Right? So it's a bit complicated, but it's the pain we need to go through. I think this is a great graph. It kind of explains where we started, and you can see the dotted lines are inflation rates, the solid lines are interest rates. And you can see from 2018 to 2020, they kind of went hand in hand. They're very close together. And then what we did is we dropped interest rates just in the beginning of 2020, and inflation came down with it. And then right about here, we started giving out money, CERB and cash. And so now we had very low rates, and we're handing out money. What happens? Inflation starts to go up, right? And then we let it run for a long time. And now at this point, the government says, uh-oh, we're way too high on the inflation side. What are we going to do? Let's start cranking up the rates. Fastest rate increases we've seen in the history of Canada. And as a result, they start coming back down. So we suspect that the government's going to keep the BOC higher until these rates converge. And then once these rates converge, what kind of coincides when they're calling for the next rate drops, we should start to see rates come down. But I think this is a great graph in terms of showing us where we've been, why we got there, and where we're going. Any questions on that?
Do you think that rates have been held high for too long and that it's negatively impacting the market to a point where they don't want it to be doing that?
No, I think they want to do that. I think everything you said is correct, except the last part. They want to negatively impact the market. We need a reset.
True.
If we don't get that reset, then we don't start to see incentives. Inflation's too high. I'd love to see a 30-year AM on mortgages for first-time home buyers, but they're not going to do anything that's going to push real estate prices up.
For sure.
We had 3 pauses, February, March, and April this year. What happened in May? Sellers market. Boom.
Yeah.
right? They don't wanna see that again. So they're keeping them high on purpose. Right? And I think they're gonna continue to do that until we start feeling that recession pain. And then once we're formally in a recession, then I think we might see some more incentives. You can't fix inflation with anything other than increasing rates. There's no other solution. So once it starts to correct itself, then they can incent. They may look at the stress test, they might look at amortization schedules, that kind of thing. They might lower rates even more.
And the market's been stressed, but it's not corrected yet, so you think there's more to come in terms of pain in the market, for sure?
It's complicated. We got some good stuff here.
If you look historically in the 80s when this happened the last time, they dropped things too quickly and it was catastrophic.
Right.
So I think that's their fear, is that if they, like what happened, you said in May, if they show that it's easing too soon, the market will take off again. And then the statistics from the 80s, 90s is way, way, way worse than what we're trying to do. They're trying to do.
Well, you got inflation in, some places like Turkey at 30%. Right, that we can't handle that. We can't handle 3%. Can you imagine if we were at 30%? It would be devastating. So this is kind of how inflation works. And I just wanted to post this graph so you get an idea of what tomorrow's gonna look like. So when you do September of 2023, you're taking off September of 2022. And all it is an aggregate of the 12 months. So when we take off October 2022, you can see that we're contracted in September 2023. So let's assume that contraction is going to play for October, November, December going forward, because the recession is starting to take hold, or zero growth is starting to take hold. So what happens is we're going to be, other than December, for the next 6 months, we should be below the line. So every time we replace one of these bars at below the line, the average is going to come down, right? But it's not going to get to where we need to go until mortgage interest and rent starts to come down. Then we can get back to target. But it's an aggregate of the numbers, and you can see going forward, inflation should not be an issue in 2024, which means rate pressure should be removed. We should not have increasing rate pressure in the marketplace. Doesn't mean they're gonna come down, they're gonna hold them flat for a while, because they wanna make sure the market contracts. Ex real estate, they wanna see the other stuff contract. This is just a general idea of how the CPI number works as well. You can see that this was October, and the total was 3.1, but food was up 5.6, shelter was up 6.1. Some of the other things went down, 0.1 to 1.2, 0.5, 0.4. But the big news is mortgage and rent, right? That's what's killing us, is mortgage and rent is too high, and that the height of that cost is what's keeping inflation higher than it should be. But again, I don't see that coming down for a bit. So it'll continue to keep the market flat. And that flatness is what the government wants. So unemployment, so what do they want? They want to see a contraction in consumption, right? We want to see consumption contract. And when you have less consumption, you need less people. You need less people working. So we're starting to see unemployment go up, 5.7. We suspect it's going to hit about 6.7 by the end, right? Which should be enough to make that contraction firm. And when that happens, then the market should shift into that recessionary category, and we should see those costs start to come down.
So when did you have an estimate of when we hit 6.7? Have an idea, or is that just, who knows?
Well, it could be the fall, let's say, the summer, the fall. It could be quick. I'm already doing mortgage for people that are taking lines out because they don't know if they're gonna have a job next year, just for safety. But the other factor too is not only is unemployment going up, but the need or want for labor is starting to come down, which again is gonna support the inflation, right? So that's unemployment. This is the want for labor. So that need for labor is starting to reduce as well, right? Which is leading towards that recessionary goal. This is a forecast on the left is a forecast on inflation, and on the right is a forecast on bank policy. You can see they're kind of lining up, where inflation, as it subsides, comes down with the rate forecast over here, almost pretty much in tune. So they're not going to move rates until inflation is dealt with. Right. Any questions on that? But this is
Sorry, Joe, do you want to flip back for 1 second? So the graph on the right, where the forecasting is coming from, what is the source for that one? I can see the sources for the
TD
graph.
Bank.
TD Bank's
TD
forecast,
Bank,
okay,
yeah.
thank you.
And so now you're seeing here that the forecast is set for June, right? then the most recent release, we're saying that we're gonna potentially see rates come down in April now, March, April. Right, that's much better for us in our industry. Right, so hopefully we will see that, expected rate decrease around April 2024.
So that means we shouldn't plan for vacation this summer? 'Cause
Well, you know,
market is
I think when we talk about February, April, and February, March, and April this year, and we saw the impact of May,
Yeah.
we've had September, October, November, December, no bumps, and we haven't seen that same impact that we had in May. I think that's part and parcel buyer fatigue, consumer confidence, and, you know, if it gets uglier in the Middle East, things could change in the winter, but, you know, if things stay status quo, I expect us to get a jump on the real estate market in January, February. If you've got buyers, now's the time to buy. You can afford to buy in Toronto, I think any time's the time to buy. But right now, you know, there's much less pressure on conditional financing clauses, much less pressure on site inspections. People are starting to negotiate on price. That's gonna go away as soon as the rates start to come down,
Yep.
is my opinion.
Could I, as a tangent,
Yeah.
would you have any thoughts about what's going on in Ukraine and in Israel right now? How does that affect the market in general?
It's gonna be from an inflationary standpoint. If Iran jumps into the war, if OPEC starts to reduce the amount of barrels per day, that's all gonna put upward inflationary pressure on prices. Ukraine, I'm not, you know, familiar as much, but in the Middle East, the fear is gas and energy cost. And if that starts to go up, inflation starts to go up again too. And that's why, you know, I'm an inch away from really starting to push the variable product, but I'm just got that little bit of fear that, you know what I'm talking about?
Yeah, not
So a little
quite
bit of
there
fear
yet.
that we're not there yet, and just hold off. Now, people are betting on it, I got guys taking variable right now. It just might be a little soon for that. Okay. So this is GDP, so, you know, again, I don't know if this information is if they manipulate it the way they wanted. When we did the last review of this, we had the second quarter was below the line, 0.2 below the line. They've readjusted this and made the second quarter 0.3 above the line. So for that 0.2 was below the line, and this 0.3 for this quarter is below the line, we would have technically been in a recession. If you X out the 90,000 people a month we're letting into the country, we are on a per capita recession right now. But with those people in, we're not. I mean, without, we're not. So technically, we're in a recession. They're calling it zero growth. But I want to hear the word recession. I know it comes with people and job losses and pain, but we're not going to get through to the other side without a full contraction across the board. Okay. Any questions on GDP? Well, rent continued to increase. Rent increased because we had 700 plus non-permanent residents coming into the country. Inventory is increasing, so rent is starting to soften a little bit. I think that'll continue to happen over the winter. If we continue to see more inventory come to market, you should see some pressure off rent prices. This is just to further support the conversation about contraction, right? We need to see consumption start to contract. It is. Discretionary spending is down. And when discretionary spending is down, that's the first thing that goes. Then credit lines start to get used. Then they start hitting their maxes. Then we see defaults on unsecured product. Not so much the secured product. We see more default on unsecured product. And default on mortgages generally happen after. Now we might be able to get to a reduction in rates before that default in mortgages happen, but maybe not before the default on the unsecured stuff. So if you have people that are concerned about employment or concerned about unsecured debt, do it now while you're employed and you have good credit. Because most people let their cards slide, and then when it gets unbearable, they're getting calls every 7 days, they start to do something about it. But by then you're going to be paying 4% over market. Do it now with a line of credit. While you're employed, while your credit's good, it'll be a lot cheaper. Holiday spending is already starting to contract. 11% less in 2022, breakdown of 1347, gifts are down 18%, gift cards are down 14%, and charitable donations are down 40%. So charity starts to wane when things get tight. But this is again just to support the fact that the market is starting to contract. As well, level of reduced spending means that many have maxed their unsecured credit Credit card delinquencies start to rise more rapidly back to pre-pandemic levels. Following this, we'll see higher delinquency in mortgages. And we're gonna talk about that in a second. So these are the rates that are out there today. 5-year fixed, as low as 539. 3-year fixed, 579. 5-year VRM, 620. Now the board's a little cluttered because now you're starting to see some rate sales. You're starting to see some specials. Lenders are like the earth. If they stop lending, it's like the earth. If the earth stops spinning, we all die. If lenders stop lending, they're gonna get crushed, right? So we're gonna start to see some more discretionary pricing, I suspect, in the summer. I mean, in the new year. Meaning right now, the best you can get on variables like prime minus 40, prime minus 50, conventional.
Yeah.
You know, I've seen prime minus 1.5 in my day. So there's opportunity for those rates to start coming down once we go into the new market. And once we're in a recession, I don't think we're gonna see anything that's gonna incent more business while we're not in a recession. I think everybody is in agreement in terms of the banks and the government. They wanna see that recession and then they'll start incenting. Because by then, we'll have contracted so much that if we start to incent, it's not gonna be inflationary, it's just gonna bring us back to market. Right?
Yeah, you're seeing it with promo rates and stuff coming out that we haven't seen in 6 months,
Yeah.
that lenders are
It's the
starting.
first night, there's sending me something every day,
Oh,
rates
yeah,
rates are
they're
going
like
down.
promos of everything, trying to get business, because they're feeling it now.
Well, they're jacking comp, right? So now
Yeah.
they're gonna
Oh,
pay
yeah.
us an extra 20 basis points over and above our compensation, but that's not, I can't use that. I gotta use that to buy down the rate. Right, so they're not posting the lower rate, they're giving us the option to sell
Yeah.
the commission to reduce the rate. But you know, there's just one thing I wanna point out, non-income qualified, it means that you don't have to declare your revenue in your CRA. So you're not declaring your full revenue to CRA. So if you're a realtor, you get a T4A, usually write it down by 50%, right? Here,
Sorry, you
714,
can please say that again?
if you're a realtor, you get a T4A,
Yeah.
right? Let's say it's 150 grand.
Uh-huh.
Most realtors will write off that from the 150, they'll write off a bunch of expenses.
Yeah.
And then declare a CRA, 70 grand.
Yeah.
Right? I can take the 150 as income. I don't need the 75, right? So that means, but you're paying 714 compared to 692. But so it's costing you, let's say 30 basis points more. 30 basis points more on 500,000 is what, 1,500 bucks?
Yeah, versus
Versus
20,000
versus 20,000 income tax. So best price doesn't always mean best solution, because you gotta consider your financial position overall. You gotta look at your debt and your mortgage, all macro, you can't look at it micro. And I talk to people, somebody, I'm sure you do as well, they all focus on rate, but rate's not necessarily the best solution for that person, right? So we have to explain that. So this is a good graph. Shows us, by the end of 2023, 47.2% of mortgage customers will see an increase in their payment. And if interest rates continues to be at an elevated level, it will have an impact to 85% of all mortgage holders by 2025. So the chart on the left shows that red dotted line, that's the share of household mortgages. It's only about 40%, right? So not everybody's getting beat with mortgages. And then when you look at the breakdown, it shows that by 2026, the market will have gone, with the rates will have gone through 98% of the bank's books. Right, so there's a sweet spot in here where they're gonna need to get the rates down, so most of these people don't get crushed, right? And I think that's what they're trying to get to the recession sooner, so they can now start to incent, reduce rates, so that as these mortgages come up for renewal, they have a little bit less pressure on the payment, in terms of the shock, right? Does everybody understand that?
Mm-hmm.
This, I just wanted to point out that the government said about a year ago, if you can't afford your mortgage payment, we're gonna let you keep that old mortgage payment, and you don't have to make the ups to cover the difference. What we're gonna do is we're gonna increase your amortization. So I've seen amortizations go from 25 years to 78 years, right? At 80 years, it's negative amortization, right? But you go to the UK, you can get a UK mortgage with a 100-year AM, right? So that's coming, right? Japan, you can get I think a triple-digit AM as well. So that could be coming based on prices. Homes become more generational in a certain part of the city, right? So when you see that, so the government's saying, okay, that's what we did, now we'll still allow it, but we're gonna start keeping an eye on it. So they're gonna make it more expensive for the banks to let people do that. But right now, this is the big number. 35% of all the banks' mortgages are not making full mortgage payments. 1 in 3. Right, how many people here, 15? That means 5 of us aren't making our full mortgage payment if we all had mortgages, right? So that's a big number. In my day, we used to call that arrears. Now they call it negative amortization. At some point, that amortization has to be made up, right? So I suspect what they're gonna do is as rates start to come down, they're gonna dial back on the people they're helping, and those people are either gonna lump sum that shortfall of interest that's accumulated, or they're gonna have to sell in the market. And if rates start to come down and we put more supply into the marketplace, with rates coming down and more negotiation on supply, we should see more buyers come back to market. And that should hopefully balance the market and not do what we saw in May, which was jump right back into a seller's. You see what I'm saying? That's a big number, eh? 35%.
Yes.
So those are the guys that are listing and not budging on their price. They don't have to. They're still making their old payment. They're listing, they're not getting their price, and they have to get their price because they bought it in an elevated market. If they sold with what the market would bear today, they would take a beating and would be in a negative situation. So if they don't have to make their whole payment, what they can do is hold off until the market comes back, and then they'll sell, right? So that's keeping the market at a level kind of inflated because the banks are helping people out.
Isn't that almost contradictory to what the government wants though? Because they want to see pain in the market and they want to see the prices reset, but then you give people this out and then all of a sudden they're still afloat and the market stays higher for longer.
But the government is heavily invested in the mortgage market,
Right.
either through the banks or through CMHC.
And
So if there's a collapse in real estate, it's us that are gonna take a beating.
And-
So they don't wanna see that collapse.
And having worked for a member of parliament, I can tell you that the number one priority of a politician is to get re-elected. And there is no way that they will sacrifice the opportunity to get re-elected by causing too much pain in the market.
But if all your income is going to cover your shelter and your mortgage, then you're not spending anything on Uber, you're not Eats, and you're not spending, how many how many loans I take, or applications I take, the car payment's $1,000. So those are gonna start to go away. The Uber Eats are gonna start to go away. The 2 to 3 trips a year are gonna start to go. That's what they wanna see contract. Because, they would like to see this side contract as well, but they got too much to lose on this side, right? So keep it here, hurt the restaurants, the travel industry, the hotels, but let people stay in their homes and not have that shift too greatly over here. You're gonna have some fallout here too, but not to the degree it's gonna be everywhere else. And then when that's contracted to the point where now people have lost their jobs and rates start to come down, then you'll see some of these more come to market, right? But the bet is that the buyers will come back, because by then consumer confidence will come back. Most buyers are taking a break right now, right? So they'll come back in the spring, I'm hoping January, February. So I think next year could be a positive year.
And the Bank of Canada and the government are two separate entities.
Right.
So the Bank of Canada is trying to sit there with a fire extinguisher and put it out, and the government's pouring gas on it.
Yep.
So that's where all of this struggle is coming from, is they're not working in lockstep, they're
Well,
fighting each other.
let's go back here for a sec. Well, it's here, right in the middle of 2021, 2022. They said rates are gonna be low for a long time.
Yeah.
And then I started scratching my head right about here.
Yeah.
And never in history has the government stood in front of everyone and said, don't worry about it, borrow until you're drunk.
And that's where I took my mortgage.
Yeah,
my,
and that's
my
where-
variable mortgage.
That's where everyone did.
It's crazy, right?
There's that clip of
I remember
someone-
I remember the newscast when I saw it. Rates are gonna stay low for a huge amount of time.
There's a
Not
news
even
clip
15
of
months
someone-
later, they went up
yeah,
8 times.
asking Trudeau that, how are we gonna service the debt if rates go up? And he, with attitude, goes, Joe, rates are low, they're at historic lows. We're like, yeah, and
Boom.
60 days later, this all
So just a
started.
little tip for realtors. Adult children of homeowners are twice as likely to own a home than children of non-homeowners. So if you're marketing people, try to market people that their parents are homeowners. And home ownership rate goes from 8.1 versus 14.7 for the offspring of owners. So just a little tidbit there. Just want to talk a little bit about some market stuff. This is the sales noticing ratio in Canada. You can see we had a peak up in the sellers market, crashed with the rate increases, kind of stayed a little bit flat. As we started to stay flat, the market started to go up again because of the pause. Government said, I don't like that, so they increased rates again in June and July, and we come back down. And I think we're still gonna sell a little bit more. That's not GTA, GTA is a little bit more different. You can see that snapshot in Toronto, if we look at Toronto specifically, month over month in October, we were down 5% in resale activity. Home resale activity year over year, 6.3 down. New listings down 2.9, up for the year almost 40%. MLS home price index in Toronto down 1.7%, which is crazy. You'd think it'd be down 20% with the crack that's going on. That's how buoyant the GTA market is. Still up 1.4% year over year. So this would be 23 versus 22. We saw 8 increases of 5%, and the housing market still went up 1.4% in Toronto. Is it a good time to buy in Toronto? Absolutely, it's always a good time to buy in Toronto. And then if you look to the far right, you can see that most everywhere is in a balanced or seller's market except GTA. GTA is still in a buyer's market, but no one's buying, no one's selling, right? Because people are staying pat, they're holding their price, and they're taking it off the market if they're not getting their price. So, people are renting out, you can rent out a room in your house for $800 a month now. So if you're struggling, rent out a room. You can, makeshift a basement apartment for 25 grand. Do that. People are telling their nephews and nieces, come back, live with me. Why are you splitting a $2,500 a month rent? I'll only charge you $500 a month. So people are finding a way to make those mortgage payments work. This is an example, and this is what I'm talking about. Where's the anomaly here? So Toronto, highest increases in listings, no resale. Resale's down, right? Why is that? Because people are holding pat. Why are they holding pat? Because the bank's not kicking them out of their house. They're not making their full mortgage payment, and they're allowing them to stay there. So the market's buoyant to some degree because of the influence of the banks allowed by the feds, right? Or else, this number would be up quite a bit. It would be like some of the other cities. But it's down. It's because people aren't selling. They're not selling unless they get their price. And they're not being forced to sell. Right? So that's kind of an anomaly, right? You don't usually see that too often. So real quick, this is the last piece of the presentation. Now's the time, if you're gonna do anything with First Home Savings Account and the RRSP program for first-time home buyers, now's the time to do it. You put your money in an FHSA today, you can pull it out tomorrow. If you put in $8 grand, you should get a credit for almost $2,500 in income tax. Income tax that gets deducted off your paycheck from the year before. So that's lottery money. Same thing with the RSP. You put 35 grand into an RSP, you can use it in 90 days to buy a house, not taxed. But that 35 grand gives you a tax break of about 12.5. Right, so now if you do your taxes in January and you make these investments today, by February you can use all the money. And if you do your taxes in January, that tax credit of 15 grand, it's real money. They send you a check. Right, that money's income tax was deducted off your pay for all of 2023. So this is newfound money, and people don't take advantage of it. You need to take advantage of this. You can take your house savings from 43 to 50 grand just with the incentives, or close to it, right? So strongly recommend your clients to do this. This is just a little bit about us. We pay referral fees. We do live video meetings. However our clients want to meet, we meet. On the right, you can see there's nothing we don't do. Pre-approvals, commitments, rate holds, resale, residential, non-residential MLI, acquisition and construction. I need to talk to you. Non-qualified projects, so we do fully qualified residential and commercial, fully non-qualified residential and commercial. Projects, we talk about the laneway homes, garden homes. We can do the acquisition, the construction, the takeout, and assess the takeout before acquisition for whether it should be bank, trust, or MLI. That's all gets worked out together. Reverse mortgages, huge opportunity for reverse mortgages today. It's one of the best products out there for seniors. Completely different than it was when it was launched in Canada, and 1,000 times different than it was in the US. And in fact, if you're 70 years old, you get a reverse mortgage, there's no time limit on it. You get to stay, as soon as you're approved, you get to stay in that house until the day you die. You can never be asked to leave, and if the mortgage exceeds the value of the home, it can never be charged to the estate. It settles on the real estate. So it's a great program. We've had seniors that have a $2 million home. We give them $800,000, $900,000. The home's free and clear. They get the cash. They buy a condo. The condo's free and clear. Now they're renting it for $3 grand a month. They just supplemented their CPP and, you know, old age retirement by now having, so now they can stay in the big home for a few more years, pay someone to cut the grass, pay someone to shovel the snow, pay someone to clean the house from the rent they're getting on the condo. They can take that rental income and they can deduct the interest on the reverse mortgage because that money was used for a rental purchase. So it's just sweet for them, right? And then in 5 years, the stairs get to be an issue. They sell the big house and they go already move into the condo. So reverse mortgages are great. You can do up to 3 reverse mortgages with one person. So they can do a reverse mortgage on the senior's place and they can buy 2 new construction products and have the down payment covered for them and 1 child or for them and 2 children, right? So it's just a really good program right now that's available. And then we do ongoing presentations like today. We do first-time homebuyer sessions, investor sessions, senior sessions. We do homebuyer live video sessions with realtors and their databases. Nothing really we don't do. And that should be it. Anybody have any questions? Now,
We do have time for questions. so-
yeah, so for going forward, was this kind of material
It
helpful?
was great.
That was amazing. Thank you.
All right, good, good. Any questions from anyone? No, we're good. All right, I'll stick around for a bit.
Awesome.